Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Zach Unger, our Senior Investment Analyst. So thankful you could join us this week. We do have quite a bit to discuss with you. We'll be talking about that Moody's downgrade, which you may have seen, and we'll talk about what that means, at least from our perspective. And then Zach's going to update us on international fund flows. We talked about that last week, but we're going to pick it up this week and kind of talk about potential runway and look at where valuations stand, and then also infrastructure, something that doesn't get a whole lot of talk in terms of an investment solution, but we are going to hit that and how we think about it and where we see some opportunity. So a variety of topics for you today. So let's dig into the Moody's downgrade, which took the United States down off of its top credit rating. Now, several thoughts about this. Part of the catalyst is this chart right here, which is the U.S. deficit going back into the late 60s. The chart shows you the deficit as a percentage of GDP. A lot of times we like to throw around things in the trillion and nominal dollars, but it's important to understand that the economy has grown, and the most constructible and useful way to look at it is a percentage of GDP. And if you look over time, we spend more time than not in a deficit. And for those of you who have been to Thirdly's, I've done a lot of talking about this and why I don't always think that's portrayed correctly, or why that's not always a bad thing, just my economic opinion. But we usually spend time in deficit, save for the late 1990s where we turned to a surplus. But going into the 2000s and beyond, we took it to the next level. The great financial crisis and all the stimulus efforts. Out of that, we produced a big stimulus or a big deficit before clawing our way back. And then COVID, of course, took us back down, and we've stayed in very aggressive fiscal posture, meaning we are spending more than we're raking back in tax dollars. So now that we have a bill working through Congress, we could have a vote this week. And as there's some color on that, that was part of the narrative, part of the reason for Moody's downgrading the rating here, is that we are keeping this deficit on the negative trajectory, not moving back towards a balanced budget or something towards zero that would put us on a more sustainable or a less debt trajectory is enough to prompt the move. So here are some thoughts. Number one, in terms of market implications, this is not a surprise. In fact, the process began all the way back in 2011. There are three major ratings agencies. You have S&P, Standard & Poor's, you've got Fitch, and then you have Moody's. So S&P did it all the way back in 2011, and Fitch did it a couple years ago. And so Moody's joined in the party, and removing that, not so much of a big deal. We know the debt story. And more importantly, in terms of the chaos in the market, back in 2011, markets got a little chaotic because A, it was a surprise, and B, so many of the financial contracts and the way Wall Street trades were written that investors needed AAA quality paper as investment collateral. We're getting really deep into the weeds here, but I'm going to explain why it's different this time. And so that AAA status being lost could have been a big deal, because that meant all the government bonds, which by and large are the collateral for trading contracts, they could no longer use treasuries if two of the rating agencies were to downgrade them and lose that status. But in the meantime, in the years that followed, those contracts were rewritten and said the collateral would be either AAA or government securities. And so the chaos and the turmoil potential of the market, not quite as much. So not a whole lot of terms to see in terms of market movement, although the stamp and the direction should be noteworthy. So finally on Moody's here, they took us down a notch, but put the rating status on a stable outlook with three caveats, or three major points that would really need to hold true to maintain that stable outlook, which really does need to happen. We really can't go down another notch before we really start to see this sell America trade gain steam. And I don't see that happening anytime soon, but these are the three factors that the Moody's would need to see in place. Number one is that the role of the US dollar would remain in play as a global reserve currency. And to date, that is not under risk at any case. It has gotten even stronger over these last several years. So no problems yet with number one. Number two, effective monetary policy led by an independent Federal Reserve. So where you get into trouble with countries around the world when they run into trouble and really lose credit ratings and see their interest rate skyrocket, or where you don't have central bank independence. So that's where you have problems. And what happens there is that you have politicians then in charge of monetary policy, which is a terrible idea because they will always do to serve today as opposed to stability for tomorrow. So an independent Federal Reserve. And then number three is the separations of powers within the Constitution upheld, that we have three branches of government, that we have checks and balances, and preserve our democracy. Those three things would have us on stable outlook. So my quick summary there is it's a big splashy headline, but nothing really to see economically. In fact, I would say one of the things that shouldn't be left behind out of the fiscal policy and the bill that would run through Congress is, if we do pass an extension of these tax cuts, would very likely be stimulus for the economy, at least in the short run. So market participants coming into the year kind of unclear whether or not taxes would go up next year. So taking that off the table could very well be a tailwind for the economy in the back half of the year, or at least taking away a headwind. So that's kind of a lengthy summary, but I felt it was warranted to share with you our thoughts on a big story. And now I'll pass it over to Zach, who has been patiently waiting to give you an international update.
Yeah, on the international front, specifically in the equity space, what we've seen over the past 10 or 15 years or so is dominant and persistent outperformance of U.S. equities relative to their international counterparts. This year, however, has been quite a different story, with international markets up around 17% on the year, and the S&P, or the U.S. equity market, up just over 1%, and it was actually negative up until a strong week last week. It's about 2 or 3 weeks in a row now that we've seen strong U.S. equity market returns. Well, the international market has drifted off a little bit. It's not uncommon for these relative trends, these macroeconomic trends like U.S. equity or international equity performance, to persist for long periods of time, like we've seen with the U.S. outperforming internationals for the past 10 to 15 years. So with international strength this year, the question then becomes, is this a counter trend rally where U.S. equities would resume their dominance, or is there some runway for international markets to continue to outperform? So I'll point you to the chart on the left there. This is valuation of broad international markets, the equity markets, relative to their U.S. counterparts, or U.S. equities. And you can see there, we are around a 32% discount in internationals relative to domestic equities, meaning that international equities are much, much cheaper on a valuation perspective than their U.S. counterparts. Now, we wouldn't anticipate in the coming time soon that international markets would resume or get to a place of equal valuation, but you can see there that average line in the middle of 18.2%, meaning an 18% discount to domestic equities. It would not be surprising at all for us to get back to that long-term average. And you can see that we would need quite a long runway of continued international outperformance just to get back to that long-term average. On the right there, if you break it down by sector, you really don't see a lot of discrepancy. By and large, across the board, save for the communication services sector at the top, the current discount in each sector relative to the U.S. counterpart is much, much lower than even the historical average. And you can see, especially amongst the sectors towards the bottom half of the chart, that typically what you see is international markets do trade at a discount, but right now they are trading at a much steeper discount than their historical average over the past 20 years or so. So our international indicators internally ticked over several weeks ago, and we began adjusting the portfolios accordingly, raising our international exposure both on a broad basis, but also taking a targeted approach to certain economies or certain parts of the international market that presented some strength, such as Europe and India. Moving on to infrastructure, the private side of our business, we've labeled this Core Plus for those of you that have talked about this in your family updates. We do make use of private equity. You see there in the top right part of the chart here, direct lending, and then the U.S. core real estate out on the far left. This chart is like a solar system of sorts that maps correlation to a traditional 60-40 portfolio of equities and bonds on the publicly traded side, and then the annualized total return. And then the size of the bubble itself is reflective of the yield. So direct lending, for instance, larger bubble, more yield, more income. Private equity, venture capital, not getting much income. So it's a small bubble, but you would anticipate there being growth there, which is why it is higher up on the chart, indicating higher 10-year annualized returns. Infrastructure in particular is a really beautiful hybrid asset of sorts, just in its makeup, that it produces some growth opportunity while also kicking off a yield component. So it's a hybrid vehicle that kind of marries the characteristics of direct lending in the income producing facet of that and the growth aspect of an equity of sorts. We also find in terms of correlation that it sits smack dab in the middle of our solar system here. So we have the US core real estate, we have some private equity and direct lending, but without infrastructure, there's quite a large gap in the middle. And so we find that the infrastructure allocation serves as a good middle ground in terms of correlation and annualized return, as well as how that return is made up. Just in terms of underlying dynamics, infrastructure presents some long-term appeal, primarily in that the permitting process can take quite a bit of time. And so there's some longevity to these deals. Additionally, the funding gap, meaning the funding that has been given to infrastructure projects and the needed funding, there's quite a large gap there, meaning that we are going to need significant investment into the infrastructure space to fully build out all that needs to be done. So as you see those core plus recommendations come across from your advisor, you should anticipate seeing some infrastructure in there. And this just kind of paints the picture as to why it is a part of that allocation.
Awesome. Thank you, Zach. And it's no mistake that we put you second because this is a very long video here, and to keep people for the good stuff that you had at the end. I didn't want them to click off early after you were done and not listen to the Moody's part. But thank you all for sticking around. It was a little bit of a longer piece here, but we appreciate your time as always. And if we can be of service, please don't hesitate to give us a call, 800-928-4001. Thanks so much and have a great weekend.